Hi, my name's JT. I'm here with my partner Sivi on behalf of Tenjin AI, and we're going to be helping you navigate the current macroeconomic environment.
So the financial sector is well positioned to outperform the broad market with growth catalysts, with banks benefiting from potential interest rate raises and digital payment companies being boosted by higher consumption courtesy built up demand from the pandemic. So the consumer discretionary sector is also well positioned, given that inflation hovers close to its long-term target set by the Fed, and a significant increase in consumption following pent-up demand and lower unemployment rates projected. Along with lower volatility, the consumer sector makes a compelling case to be an attractive investment for investors with growth prospects in 5G, gaming, social media, internet usage, and streaming. Okay, so in response to recent inflationary concerns, the Federal Reserve indicated that they could potentially raise the interest rates twice by 2024. If this materializes, banks such as Bank of America, JP Morgan, Citigroup, to name a few, will be beneficiaries of this due to higher profitability and margin expansions from spread expansions. Historically, bank stocks typically performed well in periods of rising federal funds rates. And as shown in the graph below, when the Fed's fund rate has climbed in the period between August 2004 and April 2007, the XLF returned 27.87%. And in the period between February 2016 to December 2019, in a period in which the Fed's fund rate increased nearly 400%, the XLF's returns of 80.85% outperformed the S&P 500's returns of 72.07%. And on June 24th, banks passed the Federal Reserve's stress test, which lifts the restrictions that were imposed on their ability to return capital to shareholders via dividends and share buybacks that were imposed during the course of the pandemic. So as a result of passing the stress test, dividend increases and share buybacks by tens of billions of dollars are anticipated starting in July. Despite the growth prospects for banks, there are a few threats that are present. There remain concerns regarding declining future appetite for loans and the continued flattening of the yield curve. Banks' profitability is at threat due to the tightening of the spread between short-term borrowing and long-term lending as a result of diminishing appetite for loans. So the chart below shows the XLF Financials ETF graphed against the index, tracking the slope of the yield curve. So during periods in which the yield curve slope declines, so do companies that they decline because they rely on loans for revenue.
Outside of just banks, we also find the fintech side of financials very attractive, especially key areas like credit card companies, digital payment companies, and P2P companies, as well as the buy now, pay later movement that we've really seen take over during COVID and that we expect to continue into the future. So on account of really strong payment and PCE data that we've seen coming out of the pandemic, especially as we begin to recover and states begin to fully reopen, we've really seen a really high rate of payment volume and payment transactions, which we expect to continue to benefit credit cards as they collect fees, and this pretty much runs in line with their top line growth. And then companies like PayPal and Square, if you can see in the bottom right, have really begun to expand their capabilities and their overall versatility, as they're no longer just taking fees from sellers and making fees on the seller side and CRM, but also in terms of consumers. They've seen really strong growth in brands like Venmo and Cash App during the pandemic, as Cash App, which releases their data separate from Square overall, unlike PayPal, which kind of aggregates their revenues. So we've been able to see the Cash App grew 85% in terms of top line growth, quarter over quarter from Q4 to Q1 of 2021. And then overall in Q1, it's up 665% in terms of revenue year over year, and also grew 440% last year, full year. And this is on account of kind of growing versatility, as it's no longer, these apps aren't just used for, quick short payments for friends or donations to charities in small amounts, but can be used for major purchases and kind of can be used anywhere. They've started to accept crypto transfers and payments, which came about after Cash App offered $1 million in giveaways, and that attracted 3 million people to make their first transactions last year using crypto, and another million so far in Q1 this year. They've also started to accept direct deposits and allow users to have debit cards, which have been in high demand, as they allow people to use their balances in regular stores and pretty much anywhere around the globe, similar just almost to like a checking and bank account, which really adds their overall versatility. So it's not just digital payments, but can also be used in store, in terms, and kind of complement their core businesses of Square and PayPal very well. And it's also benefited banks on the other side, as many like Bank of America and JP Morgan hold shares and hold a percentage of Zelle, which is currently one of the largest companies in that space as well. And then they also have the potential to expand internationally. Cash App and Venmo are also currently only in the US and only serving that market. So any potential for expansion would obviously be a huge growth driver and catalyst for and push those stocks further. And then the buy now, pay later movement, which has really revolutionized layaway in the past about year or two, has really come about and gained traction during the pandemic as consumers looked for ways that they could kind of spread out payments, especially in crunches of, when money might be tight. So the ability to pay zero interest over the span of, 3 to 6 months and make payments either at the end or kind of break up payments over 3 or 6 months has really benefited consumers, and especially in the younger demographic has really become almost an integral part of how they spend money. I believe it's almost double digits in terms of percentage of millennials that have used buy now, pay later, and which is up from about 3%, I believe, in 2019 or 2020. And then just the overall capability of these businesses to continue to expand online with partnerships ranging to almost every online store that now comes up with main companies like Klarna or Affirm, Afterpay, as well as another number of competitors as they continue to pop up across the globe as just another payment option, and so that they can kind of get their name out there for consumers. So, no longer is it just, credit card, debit card, PayPal, or one of those type of options, but they also see, the option to use Klarna and spread their payments over, have 3 payments over 3 months or 3 payments over 6 months, so that they can break it up at 0% interest, unless they pay late and miss payments, in which case there are fees. And then given the threat of inflation to the current macroeconomic outlook, as well as consumers and producers, as it has the ability to raise prices for consumers and reduce purchasing power, raise prices for consumers, which squeezes margins and hurts their bottom line, and also has the ability to induce rate hikes by the Fed to kind of curb the overall economy and kind of really pump the brakes on it. This is obviously a huge factor that can affect markets, and potentially the largest one at the moment. So currently we agree with the Fed, and our thesis is that inflation will continue to be transitory in the short term, and probably by the end of the year, we hope price levels should continue to drop off and return to normal. And in this case, we hope that investors will target consumer cyclical companies or consumer discretionaries. These include just everyday brands like Starbucks, McDonald's, Nike. And this is because their margins won't be pressured in the long term, as the majority of these companies operate in incredibly competitive industries where they really don't have the ability to set prices. Otherwise, consumers will switch to the next substitute. So rising prices really pressures their margins. And many of these companies and especially their stocks, have inverse relationships to the PPI, which is the producer price index. So as producer prices rise, these companies typically tend to fall. And then we've seen a really growing growth in spending and PCE, which is personal consumption expenditures, as you can see in the bottom left, as we pretty much return to that trend that we were seeing pre-pandemic. And so despite even the drop, we're at really high levels currently. We've hit new highs this year, and although it was steady in May, we're still at levels that were pretty much considerably higher than we were pre-pandemic, and was up. The PCE was actually up 28% year over year from the April lows in 2020. So that was obviously a great sign of the recovery. And this has really been driven by the reopening and just the return to travel, as people can continue to go out. We're seeing people go on vacation again, which is a great sign of people not feeling that they have to struggle and stay in, but that they can go out and spend money. And so we've seen TSA checkpoints skyrocket. They're increasing at an exponential rate in 2021 as demand for travel across the country and as well as internationally, if that's allowed at the moment, continues to stay strong. We've seen the Southwest CEO say that they can't even keep up with demand and that they don't even have enough planes at the moment. And then we've also seen gasoline consumption starting to rise at similar levels. So not only are people, flying, but also driving places. They're continuing to go back to work in the office outside of just the work from home environment. And those levels are expected to hit pre-pandemic levels by about the end of 2022. And then the return of these events and gatherings like weddings and concerts that, were all postponed last year has been another major driver of travel. And things like this obviously are great for economic growth, as travel isn't just buying a plane ticket. It's also, once you're there, you have to stay in a hotel or an Airbnb. You have to go eat out at restaurants, which obviously drives the local economies further. And people also typically buy clothing and other items that they need for their trips beforehand. So it creates a lot of spending and a lot of nice windfalls as well. And then another driver is the falling unemployment rate. As you can see in the chart in the bottom middle, as unemployment spiked last year, we actually saw a pretty significant drop in the PCE compared to where it had been in previous years. And this is obviously pretty intuitive, as when people are unemployed and don't have as much money to spend, they're going to spend less, especially on things like consumer discretionaries, where it's real discretionary spending. They don't truly need it. So as the unemployment rate continues to fall, people are getting back to work. We've seen really strong PCE growth, and we expect this to stay true. The Fed's estimates are about 4.5% by the end of 2021, 3.5% by the end of 2022, on account of businesses continuing to reopen, especially childcare, which will allow a lot of parents that may be staying home with their kids to go back to work, as well as the end of unemployment benefits that might add an incentive for people to kind of stay at home unemployed due to the high, just overall pay and additional bonuses that they're getting on top of that. So the end of that should allow some people to kind of push people to go back to work. And then in the case that that inflation is not transitory, we also want to protect investors. So in the case that we see persistent kind of pressure on prices upwards, we really want investors to target names with strong pricing power and really strong moats. So these would include Adobe, as I mentioned, Nike before, which have both seen really great quarters, as well as Google and Facebook, which aren't really as exposed to the production side and are more digital companies. But in terms of strong moats, this can mean just an overall great brand loyalty and a high brand value. So companies like Nike and Apple that may price well above their competitors, they still generate a ton of top line revenue and are able to pass on cost to consumers due to really strong brand loyalty, and they just have avid fans that will continue to buy their products no matter what. And then companies like Adobe, which are obviously just needed, and so they also have that ability to pass on costs. We also really like the commodities market, as gold's just been seen as historically as an inflationary hedge and as a safe haven asset. And we've really seen, as you can see in the bottom right, there's a similar pattern as in the changes of CPI and the change in gold. And we've seen this even recently, as there's been a huge drop off in the price of gold, as Jerome Powell's kind of continue to insist that inflation will be transitory and we don't have to worry about continued rising prices into the future, and especially into 2022, 2023. Materials companies are another historical outperformer in terms of inflationary periods. And this is because they can also benefit actually from rising prices, and they are the ones that are typically selling to producers. So they'll benefit from rising metal prices or just overall rising commodity prices, and they have the ability to pass on to consumers. And as I mentioned, they've historically outperformed in terms of high inflation. And then energy and oil overall, from the bottom right chart, you can see oil and the CPI changes have been pretty much mirrored since about 2017, 2018. And we expect this to kind of continue, as again, it is a commodity and changes with output, and they can kind of continue to expand and contract output in terms of OPEC's kind of at OPEC's discretion. And we also like the energy market, given the kind of overall switch to renewables. And even in oil and gas, we've seen some catalysts in terms of future kind of squeezes in terms of supply, given the really low levels of investment that we've seen in the areas of exploration and drilling. So that could lead to a supply shortage in the future, driving prices higher. And we've already seen oil futures that investors are expecting as high as $100 into the future. And then tips, which are Treasury inflationary protected securities are another low upside defensive play for investors that are especially conservative and really just kind of want to keep their capital stock where it is and keep their account or retirement balance where it is, and really aren't looking for an upside play, but just kind of want to keep their money where it is and don't want to have the value diminished by inflation.
Okay, so as a result of the COVID-19 pandemic and the lockdown periods, there have been a significant spike in social media, gaming, streaming, and internet usage. So such services are anticipated to enhance user information, grow their audiences, and further engage users over the coming decade, which presents a growth prospect. So as of Q1 2021, there's been approximately a 13% year-over-year growth in social media users, with around 316 million new users joining social media platforms in 2020. And considering, even though despite we're entering into a recovery phase, there is a high rate of retention among social media users anticipated, because such services are easily accessible and meant to keep the users engaged for as long as possible. So consumers of social media will always have these services by their fingertips or in the pockets, as they can easily access it, regardless of whether they're at home or not. So considering this high rate of retention, companies such as Facebook capitalized on this courtesy of high-priced ads, with a 60% rise in advertising costs. And as the chart on the top right, sorry, not top right, the chart in the right depicts, media, pure play internet, and cinema companies are paying a premium in 2021 on advertisements to promote their services. And during the lockdown period, people have spent more time playing video games, with a 35% increase in usage reported, with a staggering 8.8 billion hours of video game streaming reported, with companies such as Twitch, Facebook, and YouTube being the prime beneficiaries. And during the lockdown period, consumers spent nearly twice as much time per day utilizing streaming services than compared to the pre-pandemic. And as of Q1, with the 36% increase in streaming time, there were more subscriptions than people in the United States, with 1.03 subscriptions per person on average in the United States, which can be explained by the average person signing up for multiple services such as Netflix, Amazon Prime Video, HBO, or Disney Plus. As far as 5G is concerned, it continues its surge, with increasing implementation in the United States and increasing use in businesses and households, which are expected to upgrade their internet speeds and bandwidth to adjust to the demands of a post-pandemic world. And so by 2025, more than half the global population is set to have access to 5G services, or approximately 4.41 billion people worldwide. And over the next few years, billions of people worldwide are anticipated to gain internet access, with tech giants like Google aiming to capitalize on this opportunity. So compared to other sectors, communications ETFs have significantly lower betas, which indicates limited downside risk and lower volatility relative to the broad markets and other sectors.
And then as a result of a lot of these strong growth prospects and overall historical performance, especially in inflationary periods or periods of rising federal funds rate, we really like some of the following ETFs. So in terms of financials, fintech ETFs like TPay and Finex, which has a really strong Tenjin score with a 4.84 out of 5. So not only do we like it from a qualitative perspective, but also from an AI perspective as well. We really like those, especially as they have really strong exposure to brands like Square, PayPal, as well as some of the BNPL companies and credit cards. And then bank ETFs, so like the Vanguard Fund, VFH, like has a Tenjin score of 4.87. XLF, which is the Spider ETF for the sector, has a Tenjin score of 4.88, and KBWB has a score of 4.65. And then if you're looking for dual exposure between fintech and banks, and you really like both of those industries, like we do, JHMF is a great option there. With strong spending habits and a hopefully transitory inflationary environment, We really like ETFs like RCD, VCR, and XLY in the consumer cyclical sector, with especially kind of importance and emphasis on RCD as in an equally weighted index with a Tenjin score of 4.91. So given that it's an equally weighted index, brands like Tesla have considerably less weight, so it's only about 3% of the index, whereas in VCR and XLY, so if you're more of a risk-on investor or just a fan of Tesla, those have about 10 to 15% of holdings in Tesla, and so they're slightly more risky, but also, as you can see, have great Tenjin scores, as well as exposure to a lot of other great brands within consumer cyclicals. And then in terms of communications, we've obviously seen great growth in terms of streaming, gaming, and social media. So we really like brands that kind of encompass almost all of those, especially with Google and Facebook, which are heavily weighted in the ETFs XLC and VOX. XLC holds about 50% of their weightings in Google and Facebook, and VOX holds about 40%. And given the overall low volatility and low betas of the ETFs, especially driven by the fact that they're made up of a lot of telecom companies and then large caps like Google and Facebook, which also have relatively low betas, they also have incredibly high Sharpe ratios and incredibly high Tenjin AI scores, with Sharpe ratios around 1.4 and Tenjin scores pretty much almost at the maximum of 5.